Today we are going to discuss on the chapter Money and Credit. An overview of the chapter. We are going to deal with the topics money as a medium of exchange, the modern forms of money, loan activities of bank, two different credit situations, the terms of credit, formal sector credit in India, and self-help groups for the poor. Before going into the details of the modern currencies, let's discuss barter system, a system of exchange in which goods and services are directly traded for other goods and services without money. A few limitations of barter system are there are many products which cannot be divided. And the next is deciding the value of goods is sometimes very difficult. For example, if a farmer wants to sell 1 kg of wheat for a pair of shirt, the shirt owner can also demand 2 kg of wheat for that same shirt. And the most important is double coincidence of wants is necessary. It means that both parties have to agree to sell and buy each other's commodities. For example, if a farmer wants to sell his wheat in exchange of shirt, he has to find a shirt owner who wants to exchange shirt for wheat. Here actually money comes as a rescuer and money eliminates the need of double coincidence of want. Money and its functions. Money can be defined as anything that is generally accepted as a means of exchange and at the same time acts as a measure and store of value. And money also acts as an intermediate in the exchange process and therefore it is called as a medium of exchange. Initially, coins came into use and the coins were initially made of precious metals like gold and silver. When the precious metals became too precious, ordinary metals were being used for making coins. Paper money or currency notes gradually took place of coins, and although coins of smaller denominations are still in use. The currency notes and coins are issued by the government of an authorized body. In India, the Reserve Bank of India issues currency notes. On the Indian currency note, you can find a statement which promises to pay the bearer the amount which is mentioned on the currency note. Law legalizes the use of rupee as a medium of payment that cannot be refused in settling the transactions within India. And no individual in India can legally refuse a payment made in rupees. And now to see the advantages of money, it removes the coincidence of wants, it takes less storage space and is easier to carry. Liquidity of currency is easier. Nowadays we know that there are many instruments which are available through which it is not necessary to physically carry the money. Now let's discuss what is a bank. A bank is a financial institution who deals with money and credit as its regular course of business, and it accepts deposits from the depositors and grant loans to the needy borrowers. Most of the people need only some currency for their daily needs and rest of the amount is usually kept as a deposit in the banks. Money which is kept in a bank is safe and it even earns an interest and one can withdraw the money from his or her account as and when required. Since deposit in the bank account can be withdrawn on demand, these deposits are also called as the demand deposits. One can use a check instead of cash to settle payments and moreover one can also buy a demand draft from a bank to make the payments. What do banks do with the money that is being deposited by the depositors? See, banks keep a small proportion of their deposits as cash with themselves. This is usually the 15% of the deposit money which the bank retains in order to meet the everyday withdrawal expenses of the customers. This amount is enough because only a small fraction of people come to withdraw money on a given day. The rest of the amount is used by the banks to give money on credit to people who need the credit. A bank charges interest on the loan which it gives to its creditors, and the interest rate charged by a bank on the loans is higher than the interest rate given by it to the depositors. Thus, the interest is the main source of income for the bank. So you can see in this picture how the depositors, they deposit the money in a safer place and they withdraw it and get a small amount of interest. As well as the borrowers, they take loan and they repay the loan with a higher interest, through which the bank retains a part of it as its own income, and the rest is being used to pay as interest to the depositors. Nowadays, credit cards and debit cards are in vogue. A debit card, it allows you to make payments from the amount which is lying in your bank account. A credit card, on the other hand, provides money on credit. Payment through credit and debit cards is done electronically, and this removes the need of carrying cash. People often need to borrow money for various purposes. For example, many business people, they need to borrow money to buy raw materials and machineries. Even the farmers, they borrow to buy seeds, fertilizers, farm equipments, and many other things. And people also buy vehicles and houses by borrowing money from the bank. Here, credit plays an important role in the economy. And when we are talking about credit, it goes with an agreement. So every loan agreement, it specifies its terms and conditions. So that is called as the terms of credit. So here we can see that the terms of credit, it consists of the collateral security, the documentation that is required, the details of the term of the loan, the mode of repayment, and also the rate of interest plus the principal amount that has to be repaid. Every loan agreement, it specifies the terms and conditions regarding the rate of interest and the term of payment. In most of the cases, the bank fixes an EMI or equated monthly installment for repayment of the loan. And here, when we are talking about a security, the term is also called as collateral. Collateral, it is an asset which is owned by the borrower and is used as a guarantee to a lender until the loan is repaid. It can be a land, house, vehicle, livestock, deposits with banks, insurance policies, gold, and many other things. And if the borrower fails to repay the loan, the lender reserves the right to sell the collateral to obtain the payment. Now let's see the sources of credit. There are two important sources of credit. One is the formal sector and the other one is the informal sector. The formal sector comprises of banks and cooperative societies, while the informal sector consists of money lenders, friends, relatives, merchants, and many other people. While the formal sector is bound by the rules and regulations of the RBI and charge the prevalent rate of interest as per the RBI guidelines, the informal lenders are bound by no such rules. The informal lenders, they usually charge a very high rate of interest, and the high rate of interest can lead the borrowers into debt trap. The borrower is seldom able to escape the never-ending cycle to loan repayment. Many people in the villages are too poor to qualify the requirements of creditworthiness of banks and cooperatives. There are many others who may not even have enough documents like residential certificate or income certificate. Such people are usually at the mercy of informal lenders. But now the situation has changed with the support of the self-help groups. Self-help groups are the recent phenomena, and it comprises of 15 to 20 members, and the members, they pool their savings. The collection is then utilized to lend small amounts of money which may be required by any of the members. The group charges interest on the loan, and the arrangement of loans through self-help group is also known as microfinance, because the small amount of loan is involved with the self-help group. So here we can see that a regular group with some saving, they are eligible for availing the bank credit, and these groups are created with the purpose of creating self-employment opportunities for the members. Now, self-help group of women have been a great success in making women self-reliant in India. It was the Grameen Bank of Bangladesh which began experimenting with microfinance. The founder, Mohammed Yunus, was conferred with Nobel Prize in the year 2006 for his efforts at improving the lot of the poor. As we can see the model of the Grameen Bank here, the poor women are given a loan to start an income generating activity, and from the profits earned, the women, they repay the loan with a small interest. With a small interest earned on the loan, the bank again gives loans to improve the other poor people. And for the local development, like loans on savings account, pension, education, empowerment of women, distribution of dividends to the poor as shareholders, the bank provides microloans and banking services to the poor. Self-help groups have helped immensely in reducing the influence of informal lenders in rural areas, and many big corporate houses are also promoting self-help groups at many places in India. I hope that you have understood all the topics of discussion of the day.